And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the first day of May. Yep, already getting ready to go for the summer. Already here, already. Temperatures heating up outside. And hopefully the markets will do a little bit better this month than they did last month. The question, of course, is will April showers bring May flowers? And that's what everybody's kind of hoping for. April turned out to be a very tough month for stocks, really kind of across the board. It didn't matter whether it was NASDAQ, S&P, pretty much every major sector ended in the red for the month. And this is, kind of just part and parcel of what's been going on all year long. And look, let's go back to 2021 for a second and talk about where we were then. During 2021, we had a year where the average drawdown was about 4.5% to 5%, very minimal. And every drawdown was a buy the dip opportunity. And as soon as we got down to 5%, we kept talking about all last year, every time we come down, touch the 50-day moving average, 20-day moving average, that was a buy the dip opportunity and markets would go running off to new highs. And this was because the Federal Reserve, of course, putting in $120 billion a month in QE. We had checks going to households in 2020 and 2021, and that led to just this really incessant rise in the markets. And now the markets are down about 12%. And I had said back in 2021 that when we got a real correction of 10% or so, it was going to feel a whole lot worse than it actually is. And that's exactly what's happened this year. The market's down about 12% for the year. Everybody is convinced the world is now ended. I can't tell you how many podcasts I've done here recently with people. They're convinced the world's coming to an end and we're about to be in this major bear market. And look, I'm not saying that's not possible. We could certainly have a bigger bear market coming. We have the dynamics for it. But as negative as sentiment is right now, and again, we're talking about investor sentiment at the lowest level since the 70s, right? I mean, there's like nobody right now that wants to be invested in the financial markets. That's typically a really good time where you see markets rebound from lows. And look, we've talked about this a good bit. Markets are now trading exactly where they were, back in the bottoms in March or late February when we were talking about Russia invading Ukraine. That was exactly where the market bottomed back then. Since then, the market has gotten now very oversold on multiple levels. Money flows are very negative right now. And this is kind of that setup that you need for that reflexive rally. All you need is a bit of relief of some sort. Now, what could that be? What kind of news could we get that would be a relief to markets? Well, that could be the Federal Reserve on Wednesday. Markets are pretty much have priced in several rate hikes by the Federal Reserve. So any type of news from the Federal Reserve that says they might be softening their stance or they're maybe a little less concerned about inflation. Maybe they say something like, we think inflation may have peaked back in the first quarter and when we kind of see, slower rates of inflation ahead and, we're going to tighten monetary policy here a bit, but we're watching our employment numbers, we're watching our price stability. Any type of news that suggests that they may back off some of their more aggressive stance that they've been talking about, that could lead to a fairly sharp reflexive rally in the markets. And again, you could have a rally that takes us just back to where these peaks were back in early April, and that would not be that significant of a rally here in terms of how far we've come, but that would be a 5, 6, 7% advance from where we are currently. And of course, that would certainly allow you to reposition your portfolios a little bit better. The one thing that happens during these sell-offs, and again, last week, very tough week, really didn't go much of anywhere for the week though. We started out on the upside, went down on Tuesday, up on Wednesday. Thursday we kind of flopped around, went up, had a nice rally day on Thursday. Friday gave it all back up and a little bit more. But really overall net of the week, we kind of really went nowhere between Tuesday and Friday. So, very challenging, but that really weighs on psychology. And this is where as investors, we tend to start making emotional mistakes. It's like, oh my gosh, I got to get out of the market. Any rally I'm going to get out. And that's where what happens typically is that we kind of get this capitulatory selling. Everybody just kind of dumps in the markets. And Friday kind of looked a lot like that. And that's where you kind of see a short-term bottom. Markets rally back. That really frustrates investors. Then they jump all back in. And then that's where you get your next good setup for, selling and taking profits and raising cash. So again, kind of keep a watch here. Now, I'm not saying that we're going to have a rally back to all-time highs. All I'm saying is that the markets are now negative enough, and have been, really. This has not just been this week. We talked about this over the last 2 weeks, really, is that sentiment is so negative. Positioning is so negative right now. People are so concerned about the markets. That's typically where you get a reflexive rally. In our weekly newsletter, if you go to the website, realinvestmentadvice.com, click on the newsletter link. In this past weekend's newsletter, every week we publish several charts about risk and reward ranges. We take a look at the deviation of sectors from moving averages. How many stocks are trading below their 50-day versus the index. Also taking a look at just basic technical indicators. Our technical gauge that we run on there is a composite technical indicator of about 8 different technical measures on a weekly basis. So this indicator moves fairly slowly. That indicator is now at the lowest level we've been at since the March 2020 lows. And typically what that says is that and again, just kind of goes back to what we're saying a second ago, the markets are so negative, so oversold right now. People are so, bearish on the markets. That's typically the time that you're going to get some type of reflexive rally. Now, again, as I said, you want to use that rally to reduce risk into, sell stuff that you don't want to own, stuff that hasn't been performing well, time to let that go. And then we'll have time, to rebalance and to pick through the rubble here as we go, because again, we're likely not near the bottom yet. So probably any rally that we get, we're going to ultimately see another set of, or at least a retest of recent lows at some point in the future, because there's so many people that are now trapped in the markets from this decline. They're looking for an exit. So anytime we get rallies, and this was kind of what we saw back in March, we had that very nice rally in March, gave it all back up because all those trapped longs just wanted to get out of the markets and they needed a rally to do that. So again, that's probably what's going to happen here over the next couple of months, particularly as we move into summer, which always has a little bit lighter volume. Markets tend to be weaker in the summer. We talk about the seasonal weakness of markets during the summer months. Doesn't mean that it's going to trade negative, right? Doesn't mean that the big bear market's coming in April, in June or July, but there's typically more weakness in the summer. So we could see some rallies here. Use those rallies opportunistically to kind of rebalance risk, kind of rebuild your portfolio structure, kind of get yourself aligned with where you want to be. And then as we have the next decline, you'll be a little bit better protected. So again, a little bit better, little bit higher level of cash holdings here, certainly not problematic. I do warn you though, trying to go all into cash and saying, hey, I'm going to get back in later when the market straightens out. That's a very tough thing to do. So be a little cautious with that. But we'll come back, here in a moment from the break, and we'll talk about some of the advice that's kind of being put out there right now. And again, we'll talk about why that advice that you get kind of from the mainstream media may not be the exact advice you want to follow because of what ultimately happens to money over time. We'll talk about that when we come back from the break. I'm your host, Lance Roberts, for today's edition of the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. 6:17 on this first trading day of May. As we get things going here, of course, it's the second day of May actually, but first trading day. And again, this month we've got a lot of stuff that's going on. Federal Reserve meets this week. Of course, on Wednesday, the Federal Reserve will announce their latest policy decision, pretty much what the markets are expecting. And as long as they don't surprise the markets really in any kind of way, I suspect we might even see the markets rally on the announcement. 50 basis point rate hike, an announcement that they're going to start tapering their balance sheet by about $95 billion a month. And they're keeping a watch on inflation and full employment. And as long as they kind of stay within that context, markets will probably kind of rally on that news because it's exactly what the market's expecting. What they're not wanting, and things that of course may impact markets, is a 75 basis point hike, right, or something more aggressive. I don't suspect they'll do that, but we'll see. They've certainly done things that have surprised markets before. Also this month, though, we've got a few of the things that are going on. Lots of kids graduating from school, getting out of high school now, getting ready to go to college. That's always a fun thing. Parents are going to be plagued with having to take care of their kids all summer now. Won't have the paid-for babysitters set up. But, and of course, don't forget, most importantly, Mother's Day, right around the corner. Can't forget Mother's Day. Mother's Day is always getting lots of flowers. Everybody goes out to eat. Father's Day comes around. It's like, who?
That guy.
Yeah. That guy. Yeah, people aren't running down to Kroger parking lots to buy flowers on Father's Day, right?
No, they show up at Harbor Tools.
Exactly. The dads do, because ain't nothing happening at home for Father's Day, so they might as well go down to Harbor Tools.
Got a gift card. Woohoo!
Anyway, couple of things. So as I said, kind of finishing up the last break, that there's a lot of advice being put out right now. And I was actually driving into work this morning. I was listening to the radio, and so they were interviewing this lady from CNBC, and she's talking about the sell-off we had in April, and kind of throwing out some stats for the April sell-off. And she says, well, most of the financial advisors I talk to, they say just sit back, relax, don't worry about it, just hold on. If you've got a diversified portfolio, no big deal. Today on SimpleAdvisor.com, I just put out a series of charts, and we're going and kind of go through all the major markets, right? So S&P 500, NASDAQ, Dow, small cap, mid cap, international, emerging markets. And just taking a look at where they are technically speaking. And once you get outside of domestic equities, which have been under a lot of pressure, the rest of the world looks worse. And not just recently, this has been going on for a while, the underperformance. And so diversification has not helped you. It's actually hurt you in this case. So you get this advice, though, from the financial media and from advisors, and I use that term loosely, that you should just, buy a basket of diversified funds and just hold on to them. But that hasn't worked, not just this year. If you've owned a basket of diversified portfolio since 2009, you've underperformed the S&P 500. You were better off just being in the S&P 500. The diversification strategy has not worked since 2009. And the point about that is that a lot of the advice that's given out there is basically from Wall Street firms who just want you to invest your money into an account, leave it alone so they can just charge you a fee every year. And it doesn't really matter what the performance is as long as you're just holding and contributing to it, right? That's the golden plateau that Wall Street wants you to get to, where you just put all your money into an account, diversify it for some mutual funds, and you just add to it every year and don't take anything out. And that's great for Wall Street. Not so great for you, but great for Wall Street because they've annuitized their business. This didn't start until really kind of the early 90s was where this became a thing. Back before then, we didn't have financial advisors. We had stockbrokers. And everybody wants to criticize stockbrokers because they used to basically call people up and say, hey, you know what? There's some shares of GE for sale and, I think you should buy it. And they would get paid a commission for executing a transaction. But there was a difference back then. The difference back then was that people actually invested. The average hold time for a stock back in the 70s and 80s was about 6 years. So, yeah, your stockbroker would call you up and he would say, hey, we should buy some shares of GE and the company's doing really well, fundamentally speaking. And we were buying fundamentals back then. I remember growing up, there was my best friend lived about 5 houses down from me, and his father was the only guy on our whole street that actually had a stockbroker. And he would walk down to the end of his driveway, and this was back in the day, right? Pick up his copy of the Wall Street Journal that was thrown onto his driveway, shuffle down there in his house shoes in the morning, get his copy of the Wall Street Journal, go back inside, and he would call a stockbroker. And this is when we actually looked at what companies were doing. And by the time that a company announced earnings, for instance, let's just talk about Amazon last week. Amazon announces earnings. And they go, you know what, earnings are pretty decent, but we're worried about an economic slowdown and a consumer slowdown. Not surprising, considering where we are. Stock's down 15%. We basically wiped out, several tens of billions of market capitalization on an outlook. In moments, this happened. The immediacy of news, right? As soon as we hear about it, we react to it, and the markets are buying it or selling it or whatever they're doing. But back in the day, you would read an article that had taken about 2 days to get to you. By the time you actually heard about the earnings from Amazon, well, you didn't have Amazon back then, but from GE as an example, they missed by a penny. Outlook's okay. Stock didn't really move that much on the news. It was already kind of factored into the price. And a 1 cent miss or a 1 cent beat didn't really matter a whole lot as long as the trend of the fundamentals were okay. That's what we were buying. It's no longer the case. Markets are now a casino. And I thought it was interesting because Warren Buffett just recently had his big convention. 40,000 people showed up in Omaha and went to listen to 2 old dudes talk about money, right? Charlie Munger and Warren Buffett. Kind of like those 2 old guys on the Muppets, right?
I was thinking the same thing.
They'll make Muppets out of Charlie Munger and Warren Buffett eventually.
Say what?
But talking about the same thing, markets are a casino. We're no longer investing on fundamentals. We just simply buy it because it's going up, or we sell it because it's going down, and we have these knee-jerk reaction to news announcements. So it really, in the long-term fundamental scheme of things, let's talk about Apple. Apple killed it on earnings. Their outlook was soft. Of course. We're going into an economic slowdown. Of course their outlook's soft. Stock's down on the news. Now, not as much as Amazon, but still, nothing surprising from Amazon that they guided down. They always guide down, right? And then they come in and miraculously beat their earnings just about every quarter. But the point is that a lot of that news has already been factored into the price. These stocks are already down fairly, and some of them decently. But we're no longer trading on what the fundamentals are. We talked about Facebook. Hate the company, right? Despise the company. As a company, can't stand it. I think there's a lot of flawed problems with Facebook on what they stand for, and more importantly, they have a demographic time bomb because old people don't use Facebook. Young kids use Instagram. Now, fortunately, they own that property, but you've got to be able to buy that stock cheap enough for the value of Instagram and consider Facebook a throwaway at some point, because, again, the demographic time bomb is coming for Facebook. As old people die, they will stop using Facebook. Only the bots will live. But valuation-wise, this is a company that's growing earnings at 26% annually and has a P valuation of 14 to 16 times earnings. That's fairly cheap. Stock's down 47% from the peak-ish. So there is value, but we don't buy value, right? Markets don't trade that way anymore. And again, as we kind of go back and what Warren Buffett was talking about at his convention is that we've turned the whole market into a giant casino, right? I mean, we've got people speculating on Bitcoin. There was a lot of conversation about from Bitcoin fanatics that Bitcoin's going to replace gold as the inflation trade. It's where everything's going. It's Bitcoin. Well, Bitcoin has underperformed gold. It's underperformed the S&P. It's underperformed, just about virtually every other asset class this year. So it's not doing its job as a hedge for inflation, certainly not doing its job of outpacing, the indexes. It's certainly trading with the indexes more than anything else. And this is just because it's a function, it's a speculative asset, just like everything else is, right? We no longer trade on fundamentals. And this goes back to the bad advice that we're getting out of mainstream media. Just buying and holding a bunch of assets, it's not going to work for you. It hasn't worked for you. Just nobody asks the right questions. Sure, diversification sounds great. And for advisors that promote just buy and hold a diversified strategy, what are you paying them a fee for? I mean, you can do that yourself. Just be careful with the advice you take off mainstream media. All right, quick break, come back. Question is, of course, now, what happens next as we kind of get into the rest of this year? We'll kind of get into that a little bit more right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The Truth About Life Insurance with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Good news out this morning. Dr. Anthony Fauci says the pandemic of COVID is now over. So can we please go back to living our normal lives?
Whatever normal was.
So there you go. Mission accomplished. Amazingly, just in time for the midterms.
Of course.
The Real Investment Show podcast. Same show, your schedule.
See, we need to be thanking Vladimir Putin for his invasion of Ukraine.
At realinvestmentadvice.com.
Because it solved the pandemic.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome back to the show this morning. House Republican introduces bill to give Biden sweeping authority to wage war in Ukraine. It's interesting. There's a lot of people that are concerned right now. It's like, oh my gosh, what happens if, we get invaded in the U.S. and, they've made a remake of Red Dawn.
Yes.
With Patrick Swayze.
Yes.
They did a remake of that. And so I was watching this clip over the weekend of this guy talking about the fact that nobody will ever actually invade the U.S. because we have one thing that nobody else has.
Guns.
No, rednecks.
Well, that too.
I mean, they were born, according to him, right, they were born for this. By the time that, the military shows up, it'll just be shotgun shells and beer cans like, nope, all good. It's all taken care of. The reason I bring that up is that Governor Greg Abbott is threatening to declare invasion along the southern border as illegal immigration is expected to skyrocket. So, rednecks. Anyway.
Hey, they could do it in about a week.
I like the idea of what he's been doing, though. He's been putting them in buses and shipping them to Washington, D.C.
Yeah, I think that's perfect.
It's something we talked about a year ago or so here on the show. It's like, why don't we do this? And then now they actually did it. So I think we just need to keep doing that.
Yeah, he was listening.
Yeah. He follows me on Twitter, so hey. There's that.
Good morning, Governor Greg.
Anyway, a couple of things. We were talking about the fact that, as we look forward, into the rest of this year. So, as I said earlier, this Wednesday is really kind of the kickoff for the rest of this year because that's when the Federal Open Market Committee, Jerome Powell, et cetera, will announce their next change to monetary policy, which will be, of course, hiking interest rates by 50 basis points and starting the balance sheet reduction. At least they'll announce what that runoff will be and when it will start. So it's expected right now that it'll be about $95 billion a month, and that will start in June, and they'll start kind of rolling off that balance sheet. Now, all that means, of course, is they say, okay, we've got a $9 trillion balance sheet, rough ballpark, and every month we're just going to let $90 billion worth of maturities expire, and we just won't replace them. And that's an important point because they're not selling bonds. They're just allowing the bonds to mature, and there's a lot of short-term bills that they were buying back in 2020, 2021. A lot of the QE they were doing was in shorter duration bills. So there's a lot of bills on their books that are going to mature, and they'll just let them mature. They just won't replace them. And so this won't necessarily impact the bond market like a lot of people are expecting. Like, oh my gosh, when the Fed starts selling all their bonds, there's going to be no buyer for bonds and interest rates will go up. And that's true, but they're not really going to be selling these bonds. They're just going to let a lot of them mature. Now, they may have to sell a few here or a few there, but most of the time it's just going to be net maturities and just not replacing them. So again, this is going to be kind of the kickoff to what happens as we move forward into the year. But on the positive side, there's quite a few things that are going on that suggest we might be closer to the end, at least for now, of a lot of this market carnage we've been in since January. First of all, stock buybacks, which have made up roughly about 100% of the net asset purchases over the last several years, have been in a blackout period because of earnings. Now those buybacks are set to start again as we get towards the latter end of May. And that window is going to open back up. Currently, it's calculated at about $5 billion of demand every day in stock buybacks until mid-June. So there is a artificial buy. I shouldn't say there's an artificial buyer because it's not artificial, it's real, but it's not individuals or institutions. It's basically just corporations buying their own stock back. Amazon, Apple, a lot of other companies have been announcing increases or extensions to buybacks. ExxonMobil increased their buyback as an example. So a lot of these companies are buying back shares in order to reduce the number of shares that are outstanding, which will improve their earnings per share calculations. So in other words, it doesn't matter if my sales don't grow, my earnings will go up by the amount of the shares I buy back. Pensions also are going to have to start rebalancing, and particularly as we move further into May and June, as we get towards the end of the quarter, a lot of pension funds, mutual funds, etc., are out of balance because of the sell-off. So they're underweight equities, and there's been a sell-off in bonds, so they're underweight bonds as well. So they're going to have to start rebalancing those portfolios. So say it's a 60-40 allocation, 70-30, 80-20, whatever their allocation model is. They're going to have to start buying stocks in order to support that and get those balances back into place for the reporting period. One thing that we're also going to see that's a positive here is that there's so much negativity in the markets, right? There's a lot of put buyers that have been out there. Volatility's been picking up here. So there's a lot of option traders that are now offsides as well in terms of the markets. And if there's any type of rally in the markets, that's going to cause a reversal in that positioning, which will also add to the buying pressure of the market. So again, this is one thing I was talking about earlier. There's so much negative sentiment in the markets. And the reason I'm telling you this, let me be clear. I'm not telling you that we're about to go into the next major bull market and the bear market's behind us and it's all over with. I'm not saying that at all. What I am telling you, though, is there is a lot of indication here from various measures, whether it's technical, whether it's sentiment, whether it's positioning, that people are very off sides right now. And that typically provides for very strong reflexive rallies. And what this will cause is this will cause the media to declare that the bear market is over. See, right now you can't really have a bear market because there's too many people calling for a bear market. I know that sounds stupid, but that's just the way markets work. If everybody's expecting a bear market, everybody plays for a bear market, and then you can't really have one. The way you get a bear market is you got to get everybody off sides on the bullish side, and then that's where you get your bear market. And that's what's happened numerous times. Go back to 2008 is a good example. And we've talked about this before. You had a fairly decent sell-off, very close to what we had now this year, at the beginning of 2008. Then the markets rallied back and actually got to new highs in mid-2008. And then the crash occurred in September. And this is, the sell-off occurred around Bear Stearns earlier in the year, and it was like, oh my gosh, Bear Stearns just went bankrupt and they got sold for $2 a share, and that should have been really kind of the warning sign across the bow at that point, and markets should have been falling much, much worse than they did, but markets got very negative, very oversold, and we saw that reflexive rally took stocks back to new highs, and the media said, see, Bear Stearns, no problem, subprime's contained, it's all good, Fed's hiking rates, they got it all under control. Obviously, they didn't. And then you had the rest of the decline. And so it's kind of just where we're set up in the markets currently. It's just, markets are trying to flirt with this current bottom they're in. And it doesn't mean, look, let me be really clear. It does not mean, what I'm telling you right now does not mean markets cannot go lower here in the short term. They certainly can. Markets can certainly go lower here in the near term. What I am saying is that just be careful not to panic sell and do things that lock you out of a potential reflexive rally here that you can then use to rebalance your risk. So, you look at your portfolio, it's like, man, I really need to do something. Sometimes your need to do something isn't necessarily the best timing. Because generally, when we feel the need to do something, it's because we're emotionally duressed. And that's what's happened in the markets this year. This sell-off has got a lot of investors emotionally duressed. It's like, I need to do something. This isn't working. And I agree, you need to do something. But it's always not the best case to do it right near the bottom. And do I know this is a bottom in the market? Absolutely not. Nobody does. All we can do is look at the indications, though. And when we look at indications from, our technical composite, like we talked about in our weekly newsletter, the sentiment of investors, these things are so offsides. They're at levels that normally where the markets are down 20 or 30%, not 12. So there's certainly more downside in the markets. Certainly. I mean, we still have a lot of risks that are coming down the road that we haven't even dealt with yet, but markets tend not to go straight down until you have some sort of crisis, and generally that's a credit-related issue. So again, as we talked about this, what I'm trying to counsel you on is not to make an emotional decision. You may look at your portfolio this morning and go, man, April was terrible. You're going to open your statement. You're going to be down. And I need to do something right now. Be careful with that. The need to do something right now is generally the wrong thing to do. Not always. You may do something right now and it'd be okay. I'm just saying that a lot of the time when we have this emotional urge to do something, it's better that we step back, take a breath, reanalyze where we are, what's going on, what the damage is, and then start making a plan. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So just getting ready to kind of wrap things up here. Again, just, I just, as we start a new month here, kind of the whole premise of the show today is really just not letting emotions overtake whatever investment strategy you're following. That's really all there is to it. There's mistakes that we make as investors from time to time, which is we get on one side of the market, and we're all in the inflation trade, right? I'm long oil and commodities and that's great for right now. It's fine. It won't be. That trade will end, and commodities are generally very volatile, and you can lose money very quickly in that trade. And again, nothing wrong with the trade right now, and you're making money. You just don't forget to take some profits along the way. The one thing that we tend to do is that as investors, we extrapolate whatever thing is going on in the market, that it will be the thing for now and forever. And, I'm killing it. I'm long agricultural stocks or whatever, and I'm just killing it. I'm just printing money. And that's great. That will end. Don't forget to take profits along the way. And keep a watch out for what comes next. And generally what comes next is the thing that everybody hates the most. In 2020, we've talked about this numerous times on the show, and it's just a good example. In 2020, everybody hated energy stocks. Now everybody's long energy stocks. Just as a point. Everybody loved tech stocks back in 2020. Now everybody hates tech stocks, right? So where's going to be the next trade? You buy the stuff that people don't want. Sell the stuff that everybody wants. And it's just timing is always the issue, right? And this is where we get into these emotional traps. If I sell my shares of A, B, or C, and it keeps going up, oh my gosh, I didn't get every penny I could off the table. If I buy something that is not doing so well, I'm losing money from the things that are doing well. And that may be true. The problem is that by trying to get every last penny off the table, what happens is that ultimately prices start to fall and you go, okay, well, I'll just sell it as soon as we get back to all-time highs. And as soon as we get back to where I was, I'll sell it there. And then prices go down some more, and you're like, well, as soon as it gets back to where it was last week, I'll sell it there, and then it goes down some more, and before you know it, you're in the trap, and you give up all your gains. And it will happen very quickly, especially in commodity-related type stocks. They move very volatile, very fast. So again, just be careful. Portfolio management is, and we often equate portfolio management to playing poker, and the way a good poker player wins is they know when to walk away from the table. When the cards turn cold, they know to leave. The amateur player will keep playing just next hand. Next hand I'm going to win and I'll be back in the game, right? And then they run out of chips and you're done. And that's the way people invest. So it's nothing wrong with leaving some money on the table for somebody else. It's completely okay. And be comfortable with that. Make some money in something. Be happy with that. Be happy with what's enough and move on. There's a thing I write about once a year. I write this kind of review and talk about markets, and we talk about comparison. And comparison is the biggest fallacy that people fall into. Let me give you an example of this. I'm going to buy Brent a brand new Mercedes for Christmas. Now, Brent's going to be very happy with his new Mercedes, right? I mean, who wouldn't be happy? Brent, you'd be happy with a new Mercedes?
Sure. What color can I have?
Any color you want.
Done.
Okay. You're happy with that, right?
Yes.
Feel well compensated for your efforts here.
I am eternally grateful.
Perfect. I'm buying everybody else in the office 2 of them.
One to drive while the other one's in the shop?
Doesn't matter what they do with it. Everybody else is getting 2 Mercedes. You're only getting 1. Now, here's the problem with this, right? Brent should be happy with his 1 Mercedes, but now his first thought is, why is everybody else getting 2?
Mm-hmm.
Right? That's the first reaction. Now, why isn't Brent happy? He just got a brand new Mercedes. But he's comparing himself to everybody else in the office who got 2. By the way, this is all fallacy. I'm not really buying everybody Mercedes. It's just an example. Man. I don't want people. I'm just waiting for the emails like, you're really buying everybody a car? No, I'm not buying people cars.
What a bonus.
It's an example. But the point is that we compare ourselves to everybody else, and it has nothing to do with what we're doing. Right? Forget about everybody else. Forget about comparing yourself to some random benchmark index. It has nothing to do with you. Your portfolio, like if you want to compare yourself to the S&P, your portfolio has to be invested like the S&P. Right? You're 100% stocks, no cash. By the way, you pay no fees, you have no taxes, you have no withdrawal requirements, from your IRA. You've got no other operating cost, expenses, anything, right? See, a benchmark index is a fantasy. It's a phantom index. It's just a mathematical calculation. It has no impacts that occur in real life. It's not affected by inflation. It's not affected by bankruptcies. Stock goes bankrupt in the S&P index. They simply just take it out and stick a new one in, and the index automatically recalculates for the new value. You, on the other hand, since you actually own the companies, you sell the bankrupt company at cents on the dollar, and then you've got to figure out where the cash is to go buy the new company that has to go in at the same weight that the other company was before. So you're now actually having to contribute cash to your portfolio. Index doesn't. So be careful what you compare to. More importantly, indexes don't have anything to do with your time horizon, your needs, your financial goals. That's all that matters. And it doesn't matter whether the market's up 26% in 1 year or down 10% in a year. What's your goal? I get people all the time. People tell me all the time, if I could just get 3% a year, I'd be happy. Just give me 3% a year. Okay. I can get you 3% a year right now buying 10-year Treasury bonds. We're going to put 10-year Treasury bonds in your portfolio, and you've got 3% a year for the next 10 years. But this is the argument you get right away. But what if stocks go up? Yeah, well, what if they go up? You said you wanted 3% a year. I can lock you in and give you 3%, but now you're worried about stocks going up. Yeah, but we could make more money in stocks. True. But you said you wanted 3% a year. The problem is that we're always comparing to stuff that we don't really want. We say one thing and then we want another thing. We always want what somebody else has. We want something that the index is doing, whatever it is. We're always wanting something different. That's the problem. So the issue that we have is this comparison issue, always comparing against something else. And we've got to stop doing that, because what that leads us to is to making bad investment decisions about what we buy. 2020, 2021 is a great example of all this. People were buying all of these companies that were near bankruptcy, at bankruptcy, had no fundamental values, had no earnings, no revenue, whatever it was. You know, the ARK type companies. Cathie Wood, ARK ETF. And it all sounded great because these stocks were going up 100%, 200%. I mean, you know, we had all the meme, you know, Reddit traders that were on Robinhood, you know, buying AMC and GameStop and making 100% a day in returns. It was awesome, right? You had all this liquidity just flooding into the markets, and that game's over, as you would expect it to be. And we wrote articles talking about how this would ultimately end, and here's the end of it. And everybody's like, well, how'd that happen? It's like, well, it was evident. And this is the problem, though, is that, again, you know, we get greedy about these things, and we allow those emotions to override our logic, and then we're surprised by the outcome. And so the whole point about the conversation today is simply kind of stepping back and going, what's important to me? What's important to my portfolio? What is it that I'm trying to achieve? And building a structure that you're happy with. And forget about the rest of it. Just forget about the rest of it, because it doesn't matter. Ultimately, it doesn't matter. If you're happy with the rate of return that you're getting, the rest of it does not matter. It's just a function of getting our emotions into the right place. And this is the one thing that we consistently forget. We consistently forget these ideas because we get distracted by the mainstream media. We get distracted by, you know, red and green blips all over our computer screen. And this, you know, the biggest part of the problem with investing today is we have too much access to too much information. That's really what it is. We would all be better investors if we went back to my best friend's dad down the street with his Wall Street Journal getting information 3 days late. We were all better investors back then. A lot of things were better back then. All right, wraps up the show for the day. Get by the website. Our latest newsletter is out now. Simply go to the website, click the newsletter link talking about the first quarter GDP decline. What does it mean for the markets and kind of what potentially happens next? And as we get ready to kick off the month of May, we'll see if we can get a little bit better month than we had in April. All right, wrap up the show for today. Get by the website. Also, check out SimpleVisor.com. Our new report is out this morning on the major market review. That is on the website now at SimpleVisor.com. You can subscribe for free for 30 days. Check out the report, see the other data and portfolios that are there for you, SimpleVisor.com. See you back here tomorrow.